Hey everybody, this is Gregg Gossett from Gossett Trading and Mentoring, and today is Saturday, April 1st, 2023. Hope you're doing well. Hope you're having a good weekend. We had a big week last week for the Bulls anyway, not so much for the Bears, but I hope you had a good trading week, and I appreciate you coming and watching my weekend edition of all the trades that I entered and exited last week. And so that's what we're going to do in this weekend review. We're going to take a look at the trades, all the trades that I made, both on the daily charts and on the weekly charts. We're going to talk about when I entered the trade, why I entered the trade, and most importantly, how I am going to manage the trade going forward. That's a big difference in traders that make money and lose money, is how you manage the trade, having a process of how to stay in your trade or get out of your trade depending on what the price action does. So it was a great week for me. I'll show you all the trades. Very grateful whenever I have a nice week, and I am grateful for that for sure. But here is the here's the format of what we're going to do today in this podcast. First of all, we're going to run the U.S. legal disclaimer. Secondly, like I mentioned, we're going to come back, take a look at all the trades I had last week, when I entered, why I entered, and how I'm going to manage them going forward. After that, we're going to do a small little segment on trader psychology. Most important skill in trading is the ability to create a plan and then follow through on your plan without letting the emotions of the markets or your gains and losses get you off track and off of your process. So it's always helpful for me to teach these things, and I hope it's helpful for you as well. So it's kind of a win-win situation with that. After that, we are going to do a quick poem from my friend Frank, the trading poet. He always has great poems, always pertinent, and always, I almost want to categorize that in with trader psychology, because those poems really do have some good benefits and some good messages in them. After that, I have gone down through my watch list, my master watch list. I've gone through both the dailies and the weeklies, and I have identified some potential trades for next week that I am going to be taking either to the long side or to the short side, depending on what the market tells me it's going to do. If I have some rejections to the downside, I'll be looking for some longs. If I have some rejections to the upside, I'll be looking for some shorts. And actually, most of the time, my potential setups for the next week, both on the daily and the weekly charts, are generally long. But because we've had this market rally here, I don't have a lot of long ones, but I do have some good potential short trades that I will be looking for, and I will point those out to you when we go through the potentials for next week. So that's the plan for today. I hope it's going to be helpful for you. And I have to run the U.S. legal disclaimer, and I will be back in about 40 seconds. So hang tight. Thank you.
This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and/or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much.
All right. Well, thanks for holding through that, and let's get started. So these are going to be the trades on the dailies that I took last week, or not that I took last week, that I either took last week or that I'm in and currently showing you how I'm going to manage these. And I do want to say, in this podcast, when I show you these trades, there's a lot of rules, and I'm going to be explaining what these rules are. But with the time allotted that we have, I can't really go into all the absolute nuances because there's different rules for different strategies. But I do want to mention that if you are interested in learning to trade, if you want a teacher that has over almost 28 years now of experience and has done this for a living for a long time and has studied with many great trading teachers and mentors from around the world, then I offer a one-on-one course. It's a 15-hour course where I teach you all 5 of the strategies that I use. I teach you step by step. We go through a lot of simulations, and it's very important that my students succeed. And I've had so many students from around the world. So if you are interested, I do teach private one-on-one lessons in the evening time via Skype. The course costs $1,750, but it's worth every penny. It's really an investment to learn a skill. And my email is in the link of this YouTube video, or in the description of the YouTube video. And if you're interested, just reach out to me and we can get it started. I think you'll be very, very happy that you did, and you're really going to learn a skill. I'll talk a little bit more about this towards the end of the podcast, but just keep that in mind if it's something you're interested in. All right, let's get started with QQQs. Okay, everybody, here we go. I did take the Qs all the way back here on March 13th. Why did I take it? Well, when I look for a long position, I'm always looking for some kind of rejection of a major level. Generally, these are called deep dip buy stock trading strategies, and I nailed it down here. Why did I nail it? Why did I get in? Well, I got in because simply we had a close under the 200-day moving average, the black line, and then we closed back over. That's an important level of support, and with the close back over, it gives me a very good entry point for a good risk to reward ratio. It also had a V2 entry. Here is bar 1, bar 2, bar 2 went below bar 1 and then closed above bar 1's close, in addition to closing above the 200. So I have to position, when I enter the trade, I need to position size. And how do I position? I need to position size based upon the volatility of the market. And if you use the reading of the 2 ATR, this will do this automatically for you. Just automatically for you. It adjusts for volatility. And how do I enter this? Well, I take 1%. A good rule of thumb is 1% of your total capital. If you have $100,000, 1% is $1,000, right? If you have $50,000, 1% of that is 500. And so I take 1% of my total capital. Let's just use the hypothetical $100,000 account. 1% is $1,000. I divide it by the value of the 2 ATR. So I would take 100,000 divided by 223. That tells me how many shares to buy. Now, I always use 2 stops. I use an end of day stop or an end of bar stop and an emergency stop. Well, taking that $1,000, dividing it by the value of the 2 ATR tells me how many shares to buy, and then I buy, and then I place my stop exactly whatever the value of the 2 ATR is below my entry. If it gets there, then I get out, and I've lost that hypothetical $1,000. But that's in the worst case scenario. Normally, about 92% of the 95% of the time, if you have a loss, it will be a loss with a close below why you entered it. Why did I enter this? Well, close under, close over the 200, that got me in. It had the V1 as well. That just adds some bonus points to the trade, but I wouldn't take the trade just based upon the V1. I take it based upon the close over and the close under, and then the close over the 200. So I position size, like I just mentioned, place my emergency stop, the value of 2 ATRs below, and then my end of day stop would simply be a close below the 200. That's it. And that's to the downside, because we always want to talk about risk first. So find the entry, find the rejection of the level. Could be the 30 RSI, could be the 200-day moving average, could be the 250, could be the 300. Position size, place your emergency stop, know where your end of day stop is. These are all the defensive moves. Now, to the upside, if we move 1.5 ATRs above my entry, if we get there, then I go into trailing stop mode, and I'll show you how the trailing stop mode worked here as well. That is also defensive. Trailing stops are also a defensive move, but I also have offensive moves. Just like any great sports team, you have to play offense and defense in your trading. Well, the offensive portion of my trading is taking off a portion of my position, not all, but a portion as it moves up using the value of the 0.45 ATR. If it moves 0.45 ATRs from entry, I take a portion off. So close under, close over the 200 was the entry. I position size. I place my emergency stop 2 ATRs below. My end of day stop is a close below the 200-day moving average. I place my 1.5 ATR trailing stop level above. If I get there, I go into trailing stop mode, which basically means if I have a close below a previous bar's low, I get out of half. And then we talked about the offensive part. As it moves up, take profits. So entered here on the 13th at 290.50. Next day, moved up, took some profits. Next day, no profits, but got to trailing stop level. Next day, moved up again, more profits. Next day, nothing. Next day, we went below the previous bar's low, but closed above, so I kept it. Next day, more profits. Here on the 22nd, I had my first close below the previous bar's low. After reaching trailing stop level, I take off half. Next day, another big day up. Took more profits off. We got to a 65 RSI level, and I was just mentioning about my one-on-one course. If I get to the 65 RSI level and then I have a close below the 5 EMA, I get out of the trade. And that's what happened here. So I got out of this last half of my trade on the 28th of March because it closed below the 5 EMA. And then it just took off without me, which is fine. This happens. I have lots of other long positions that I participated in that. But yes, having a process and having rules, it's not always going to work out for you on any one individual trade. Do I wish I would have kept it? Well, of course, because it moved up dramatically. But you have to follow your process for the good and the bad. And in the long run, if you have a good process that takes into account good trading principles, that you're going to make more money than you're going to lose. And yes, there are situations like this where you'll get out because your process told you to, and it will run away from you. But it's fine because this was a little unusual that this happened. But just make sure you have a process. Make sure you follow. It's not going to be perfect. Sometimes I'm going to get out under the 5 and it's going to go crashing down and I'm going to seem like a genius. Other times I'm going to get out and it's going to go roaring up without me and I'm going to feel like, oh man, I should have, woulda, coulda, shoulda, woulda, right? But it doesn't matter. It doesn't matter. The point is having a process, following the process, and not having that angst every day of, oh, should I or should I not? Is exhausting. It wears you out. It's a much more holistic way to trade, to have the process and just follow it. And if it goes against you, and like in this situation where it just keeps going up, it's fine. It's fine, right? Just wait for another setup and follow the process. So anyway, did exit my position back on the 28th of March because of the close below the 5 EMA after reaching 65 RSI. And I got out of the second half for a gain of 5.37%. So pretty good trade. Netflix. All right. Another good example of processes sometimes going against you, but really great trade. Started here on the 14th of March. What was the signal? Close under, close over the 300-day moving average. This is the orange line. In addition to that, we also went under 30 over 30. That's great. We also went under the negative third ATR channel over the negative third ATR channel. So there is my entry point. I position size, taking my maximum allowed loss, dividing it by the value of the 2 ATR. That shows me how many shares to buy. Place my emergency stop, exactly the value of 2 ATRs below. My end of day stop is a close below the 300-day moving average. Then I place my 1.5 ATR trailing stop level above to get me into trailing stop level. If it gets to that level, next day moved up, took some profits. Next day moved up, took some profits. Got to my trailing stop level. Now I'm looking for a close below the previous bar's low. Didn't happen here, didn't happen here, didn't happen here. Did happen here, unfortunately. Got out of the set of one half of my position at my entry point. Not that it got to my entry point, it just happened to be at my entry point. This is playing defensive, right? Having a close below a previous bar's low after reaching trailing stop level. Now, I took off half. Do I wish I would have kept the other half? Of course. But I did keep the other half, thankfully. It's one of the win-win situations in trading is taking half of your position off. If you take it off and it keeps going up, you're glad you have half. If you take half your position off and it goes down, you're glad you sold half, right? So then we just went on a tear, moved up huge, took some more profits, moved up huge, took some more profits. Next day, took off took more profits off. Came back down. Next day, more profits, and more profits. Now, we are at a 6401 RSI. If it gets to a 65 RSI, then if it closes below the 5 EMA, that will be my trailing stop level. Conversely, if it moves up, rejects the 70 RSI, I will sell half of whatever I have remaining. And then if I have another close below previous bar's low after rejecting the 70 RSI, I will be completely out of the trade. So this particular trade has been a monster. Shares that I have remaining here on this trade up 14.89%. UAL, United Airlines. Okay, bought United Airlines back here on the 27th of March. Why did I buy it? What was my signal? I needed to have a level that was rejected to the downside. Well, here it was. Had a close under the 200-day moving average, close back over. In addition, we also went under 30, over 30. Great confluence of indicators. And I might want to say right now that the best entries are the ones where you have confluences and combinations of indicators lining up on your time frame, and ideally on multiple time frames as well. When we get to potentials for next week, I will show you what I'm talking about as far as multiple time frame support. So close under, over 200, give me a very good risk to reward ratio. What do? I position size, as previously discussed. I place my 2 ATR maximum allowed emergency stop below, and then my end of day stop is going to be where? Well, I took the trade because it went under 200, over 200, so therefore if it closes back under the 200, I will just get out. And most of the time, 95% of the time, the loss you take will be your end of day stop, not your emergency stop. Then I place my 1.5 ATR trailing stop level above. If it gets there, then I go into trailing stop mode. Well, that happened on Thursday, right? You can see it got to trailing stop mode, which means now going forward, if I have a close below a previous bar's low, I will get out of half the position. Alternatively, if it keeps moving up, I will continue to take partial profits on the way up. And at this point, really to the upside, I'm just going to stay in this trade until it either gets to a 65 RSI level, in which case if I have a close below the 5 EMA, I'll get out, or goes up, keeps going up, rejects the 70 RSI, then I'll take half. And then if I get a close below the previous bar's low, I will get out of the rest. That's to the upside. Or if it moves back down to the downside and closes below the 200, I'm simply out. So I don't know what the market's going to do. I don't think any of us do, but I know exactly what I'm going to do. And I really want to drive this point home. You will never know what the market's going to do, but you need to know exactly what you are going to do. And I don't care what this does, to the upside, to the downside, I know exactly what I'm going to do. And it takes a lot of pressure off you and puts you in the best position to make money, right? So this particular trade doing well so far. I am in trailing stop mode. United Airlines trade up 5.66%. Verizon. Okay, I exited Verizon on Friday. And like I said, depending on the trade strategy, you have different rules. And again, that's what I teach in my private one-on-ones. But this was a great trade on Verizon. It was a deep dip buy. Why did I take it? Well, this was simply a intraday under 30, closing back over 30. So it went down, could not find any more sellers under 30 and reversed back up. That's a great piece of information to have. Also, we had this nice sideways motion here. The day that I took the trade, we tried to break to the downside, failed, and reversed back up with a V1. Bar 1, bar 2. Bar 2 goes below bar 1's low, closes above bar 1's close, in addition to the under 30, over 30. Perfect trade, position size, place my emergency stop 2 ATRs below. Now again, why did we take the trade? Because it went under 30, over 30. In the coming days, if we have a close back below 30, I will get out, right? But it didn't. It went my way, placed my 1.5 ATR trailing stop level above here. Next day, took partial profits. Next day, got to trailing stop level, which means if I have a close below the previous bar's low, I will exit half. This happened here on the 22nd. It got to trailing stop level, closed below the previous bar's low, took a a 1.69% profit on the reversal bar, but kept half. Moved up, just tore up. Next day, had some profits. Next day, no profits. Next day, more profits. Next day, no profits. Up, up, up. And then on Friday, we rejected the 50 SMA. Now, if I take an under 30 over 30, and I have a close below the previous bar's low, or I reject the 50 RSI or the 50 SMA. So there's three situations there. If two of the three happen, I am out of the trade, and it did reject the 50 on Friday, and I am completely out of the trade on the remaining shares for a profit of 5.7%. So wonderful, great trade. I was very patient, just waited for this this setup to happen, and it happened. Again, it was under 30, over 30 with the V1. Got to trailing stop level, closed below previous bar's low, out of half, continued to take partial profits all the way up here, and then Friday it clearly rejected the 50, so my rules tell me I have to get out. And so the second half, profit of 5.7%. So thank you, Verizon. Very, very nice trade. DIA. Okay, this is another daily trade. I took back on the 28th of March. Why did I take it? Well, we had an intra-bar rejection of the 200. The market tested the levels below the 200. There were no more sellers. And I entered here at 323.90. I position size. I placed my two ATRs below. My end of day stop is a close below the 200. I placed my 1.5 ATR trailing stop level up there. On Friday, we got there. Now I am in trailing stop mode, meaning in the future, if I have a close below a previous bar's low, I will sell half. We're at a 58.49 RSI. If it gets up to 65 RSI, then the 5 EMA trailing stop level will come into play. If we reject the 70, I'll get out of half of the remaining shares. And then after rejecting the 70, if I have a close below the previous bar's low, I will be out of the trade. So no matter what happens here, if it goes down, closes below the 200, then I will get out as well, right? So this particular trade has been a really, really good one. And, you know, I just want to point out here, up 2.65%, which is a really good percentage move on the Dow, but it's all about risk to reward. If we were to just close below the 200, just get out of the trade, right? Don't think about it. Just take action, get out. But again, you need to have a process of what to do on the way up here. And of course, nice move up. I took partial profits as well. So the DIA trade up 2.65%. So those are the daily trades. Q's got out for a gain of 5.37%. Netflix remaining position up 14.89%. UAL up 5.66%. Verizon exited the remaining position for a gain of 5.7%, and the DIA up 2.65%. So those are the dailies. Let's go to the weeklies now. Weekly bars close on Friday, so I make my decision on entering or exiting on Friday when the weekly bar closed. I bought AMD all the way back here on the 24th of February on this pullback and rejection of the 200 week moving average. Position size, place my two ATRs below. If I have a close below the 200, I get out for a small loss. I place my 1.5 ATR trailing stop level up here. Next week went up a little bit. Next week went up a little bit, took a little profit. Next week had a huge move up, took lots of profits off. And now we are at a 66.11 RSI, have not had a trailing stop trigger on this particular trade, but we are at 66.11 RSI. So what does that tell me? That tells me that now the 5 EMA comes into play. If I have a close below the 5 EMA, I am completely out of the trade. So I know what's happening to the downside. If it moves up, I will continue to take profits, and I'll be looking for rejection of the 70 RSI. That's a key RSI level above us, and if it does reject the 70, I'll get out of half, and then if I have a close below the previous bar's low, I will get out of the remaining amount. And this particular trade at the moment up 21.29%. UNG. All right, this one has been a losing trade. I did take UNG all the way back here on the 24th of February. Under 30, over 30, plus a V1 entry. And by the way, if you go to my YouTube channel in my lessons playlist, I get a lot of questions and emails about V1s, V2s. They're a very important part of my trading. That's completely free. You can go and look that up. I believe the link is also in the description of this YouTube video. Just look for V1s, V2s. Watch it. They are a great addition to any trading approach. So the main entry was a under 30, over 30. I placed my position size, I placed my emergency stop, I placed my trailing stop up here above. Next week it went up, luckily took off some profits, but then we've just been going down ever since that. But look, we closed at 30.28, so I am still not out of the trade. I took the trade because an under 30, over 30. Therefore, if it closes below 30, I would get out, but luckily, we'll see, right? Luckily, but it closed at 30.28, keeping me in the trade. I have my maximum allowed loss down here at about $6. So if it does get down there, I will have to get out with an emergency loss. But still in the trade because it held the 30 RSI. This trade down 22.16%, right? But don't let the percentages scare you, because the position sizing here, if I got to the trailing stop level, all I would lose is that hypothetical $100,000. It doesn't, or $1,000. Doesn't matter what the percentages are. And that's the great thing about position sizing using the 2 ATR. So this one down 22.16%, but still holding my levels. Tesla. Okay, I bought Tesla here. We had a nice move up, nice pull back to the 200-day moving average that held. Position sized, emergency stop below. If I get a close below the 200, I am out. Put my 1.5 trailing stop level above. Next week, moved up, took a little profits. Next week, moved up, took a little profits. This last week, moved up, took a little profits. Not your trailing stop level yet, but this trade's doing well. With a current gain of 16.83%. We have earnings coming up here, it looks like, on the 18th of April. I never hold through earnings, so regardless of where the stock price is or what it's doing, I will exit prior to earnings. Holding through earnings is a great way to make a lot of money quick, but it's also a great way to lose a lot of money quickly. And our job as traders is to be risk managers. Think about risk first. And holding through earnings is a great way to lose a lot of money quickly, so I don't want to put myself in that position. So Tesla up 16.83%. IWM, man, I have been in this trade for a hot minute, but this is really a good example of why it's important to take partial profits, have trailing stop rules. I got into IWM way back here in 22. October 14th of 22 with a rejection of the 300 SMA. I position size correctly. I placed my emergency stop. It was all the way down there. And my end of week stop would be simply a close below the 300. Well, it moved up, took some profits. Moved up, took some profits. Got to trailing stop level. Continued to move up. Here's my first bar closing below the previous bar's low. After reaching the trailing stop level, got out of half of the position here, moved down, held the 300 SMA, then we had another big up move, took some profits, took lots of profits here. Never got to a 65 RSI level, so the close below the 5 EMA did not matter. Came back down, and look, here we bounced, kept me in the trade. Next week, down, but then closed back above. Kept me in the trade, and then up this week. Not a lot of shares remaining because of all the profit taking and the trailing stop levels, but on the remaining shares, this trade up 6.26%. QLD. All right, QLD was a short. Good example here of using a process, scaling out when you have potential profits. I did short QLD with the rejection of the 200. I shorted it at 46.10. position size, my end of day or end of week stop in this case is going to be a close above the 200. Next week, move down, took some profits off. Next week, didn't do much. Next week, moved down, took some profits off. Important to take them a portion when you have them. Next week, moved up, didn't take any profits. Next week, moved down, took profits off again. Next week, got to my trailing stop level because this is a short. It's the reverse. If I have a close above the previous bar's close, I'm going to take half off. And really good thing I did because I locked in half with a gain of 3.22% on half. And then this week closed above my end of week stop for a loss of 7.05%. But was it really a net loss of 7.05%? No, of course not, because I took profits as it moved my way. Took them off here, took them off here, took them off here, got to trailing stop level, have a close below the previous bar's high, where I took half of everything off for a gain of 3.22%. And the remaining shares, I'm going to give those some leeway, right? Give them some room to breathe. But we had this big rally up, and then the remaining portion of the shares loss of 7.05%. XLF. All right. Bought XLF back on the 24th of March. Nice rejection of the 250-week moving average. Enter the trade, $30.71. Position size, 2 ATR emergency stop below. End of week stop, just simply a close below the 250, which did not happen. We've rallied, placed my trailing stop level up here, 32.84. It's not there yet. Not in trailing stop mode yet, but I did take a portion of my position off at profitable levels on this week up. So happy with this trade so far. Definitely up 4.54%. And then last but not least, GDX. This one did not work out so hot. Tamale, I was really waiting for this trade. I liked it. I was surprised it didn't work, to be honest with you. Why did I short GDX? Well, I shorted GDX with the rejection of the 200-week moving average. I shorted it at 31.60. It also dovetailed with this big down bar move here. We rallied back to halfway. So from a Fibonacci standpoint, it made sense. Also made sense with the rejection of the 200. Now I have that resistance above me. Started off down, but then we closed above the 200-week moving average, and I'm just simply out of the trade. That's it for a loss of 2.32%. So some really good trades here. Just a quick recap. AMD up 21.29%. UNG down 22.16%. Tesla up 16.83%. IWM up 6.26%. QLD loss of 7.05%. XLF up 4.54%, and GDX up down 2.32%. So, not all winners, but all in all together, combining the dailies and the weeklies, really great week. Very, very, very thankful for that. So anyway, I hope that was helpful to take a look at how I manage these trades. And like I said, later in the podcast, we will look at the potential trades both on the daily and the weekly that I am looking for next week. All right, let's do a little trader psychology. This is from Peter Robbins. You can follow him at PRRO Robbins or PR Robbins on Twitter. Peter Robbins was featured in Market Wizards, the new Market Wizards or Unknown Market Wizards. I can't remember the name of the book now, but this guy's the real deal. He has a great following, and if Peter Robbins says something, it's probably worth looking at and considering. Let's see what Peter has to say here. Just because you miss getting into a trend does not make it short. And the reason I picked this one here today is I have had many, many calls from students, from friends, people that know I'm in this business. And they're like, Gregg, I missed this move. I want to short it. Well, there's a lot of things going on there psychologically. Yeah, you miss the move up. And if you miss the move up, a lot of times you're going to think, well, I'll just short this. Well, I've had a lot of people contact me that really did not do well this week because they were fighting this move up. I mean, is it ever going to end? Well, yeah, of course, but we just don't know when it's going to end. But if you miss a move up, don't just immediately think, oh, I'll make the money on the downside. Sometimes that will work, but a lot of times it will not work. Like I mentioned, in the when we go through the potential trades for next week, yeah, I have mainly shorts, but it's not because I missed the trend. It's not because I just think it's too high. I'm going to look for levels that are rejected and only take the trades if they are. I just got off the phone with a good friend of mine that got caught in this short squeeze, and she said, you know what do I do here? What's your best advice? And I said, my best advice is just get out of your shorts until you have some kind, the market tells you, or the price action tells you that there's some kind of movement back down. That would be a rejection of some kind of major moving average above, or some RSI level, or a V1 or a V2 to the entry, to the downside. But if you are in this position, don't just sit here and let the market eat you up. If you're short, I would probably, like the advice I gave her, I would just get out of the trade until the market shows you that it doesn't want to go up anymore. Then you're going to have a much better chance of having a profitable short trade. But just sitting in here and letting the market chew you up to the upside is brutal. It's just brutal. So wait for some kind of price action that it's going to tell you that it doesn't want to go up anymore. That could be a rejection of the 70 RSI. That could be a rejection of some major moving average above. That could be a V1 or a V2 to the downside, or at the very, very least, a close below previous bar's low. So hopefully most of you have been in on the have been bullish and have been long here in this nice move up. And if you have, congratulations, proud of you and happy for you. But if you're on the other side of this trade, don't just sit there and put yourself in a blender and let the market do this to you. Wait for some kind of price action that shows you that it's rejecting a level to the above or wants to come back down. Very tricky position to be in, but that is my best advice. So just because you miss getting into a trend does not make it a short. So true. It only becomes a short if it rejects some major level above or some price action to show you. So thank you, Peter Robbins. Hope you follow him at PR Robbins over on Twitter. It'd be worth your while. Okay, let's do a little trader psychology. Trading poem from my good friend Frank. Frank is a exceptional trader. He's an exceptional journalist. He's an exceptional poet and musician. And I love his poems. And you can follow Frank at FrankOD over on Twitter. Today's market poem: learn to give as good as you get. Have a positive attitude that says, you ain't seen nothing yet. Everyone makes mistakes that are hard to forget. Nothing hurts a trader like carrying regret. Isn't that good? Learn to give as good as you get. Yes, if you get good, you should give good. Have a positive attitude that says, you ain't seen nothing yet. Absolutely true. Everyone makes mistakes that are hard to forget. Man, is that true? I have been there. I have been there for sure, just like everyone else has. Nothing hurts a trader like carrying regret. This is the most important part of this poem. Nothing hurts traders like carrying regret. If you've had a bad go of it, you've had a bad month, or you've been short into this, and yes, of course you regret, oh, I shouldn't have got short. Why didn't I get out? I hear this all the time from people. That's why it's important to have a process, everyone. Have a process. That way you don't have to have the regret. If you follow the process, whether it works out for you or doesn't work out for you, following the process is the key to making money long term. Yeah, you can shoot from the hip and, hey, I think I'm going to go short. Hey, I think I'm going to go long for no particular reason. Sometimes it will work out, but if you do that on the fly without it being part of your process, then if it goes against you, yeah, you're going to feel regret. And having that regret demoralizes you and affects you psychologically. So again, I've talked about it for 585 times today on this podcast, but I'm telling you this because I care about you and I want you to succeed as a trader. You have to have a process. The process, what you do in your process is not always going to work out, but it takes so much angst and stress and emotion away from you. Just follow the process. Think about a casino. They have a very distinct process. They have an edge and they follow the process. You can only bet this much, sir, or you can only bet this much, ma'am, and you have to hit on this and you can't hit on that. They have a process. Does it mean they win every hand? Of course not. Most of the time, they win like 51, 52% of the time. In trading, you can get a better win ratio than that, but you have to follow the process. They have the dealers, they have the pit bosses, they have people looking over them. Why? Because they want to make sure that everyone in the casino, the employees, follow the process because they know following the process is going to get them the money. And it always does. You have to be the same way as a casino. You're not going to win every hand, you're not going to win every trade, but you have to have a process. So thank you so much, Frank, at FrankOD over on Twitter. All right, everybody. So what we're going to do now, we're going to look at the potential entry trades that I've identified both on the daily and the weekly time frames. I did mention at the beginning of the podcast that because of this big rally, don't have a lot of long potential entries here. I have a few, but the majority of these trades are going to be to the short side. Is it because of we've moved up and I just think it has to go down? No. I'm waiting for some kind of rejection or level for the market to tell me it doesn't like the price above this price for a short, or it doesn't like the price below this price for a long. So, and I also mentioned that it's important to look for confluences of indicators lining up on multiple time frames. So I'm going to show you what I'm looking for on the daily for these shorts and these longs, but I'm going to show you how it lines up on multiple time frames. And so this is Goldman Sachs, right? We've had a nice move up. Banking crisis cooled down a little bit, at least so far. We don't know. But look at the 200-day moving average above here. This looks like a good place that the price may stall. And it certainly may get up there. But having this resistance above you is a key level. It lets you at least have a good risk to reward ratio. It doesn't mean it's going to work out. So next week, if we reject the 200-day moving average, meaning that it goes above it and below it, maybe in one day, or it just pegs it and it bounces not off but above, if it just hits it, goes down a little bit, that's called the bounce to the downside. That would show me that there are no more buyers up here. It doesn't mean it has to go straight back down, but it helps me set up a good risk to reward ratio. Of course, I place my emergency stop above, and my end of day stop would just simply be a close above the 200. Now, I like how this price dovetails. See the big bar over here on the 10th? See the big down bar? Well, if we rally back up into halfway of this big down bar, that sweetens the probability of the trade. Just moving back up to halfway of here, there will be some inherent Fibonacci resistance, 50% resistance, and that dovetails with the 200-day moving average as well. So there are multiple areas here where there's some resistance. Now, I drew the line at the 200-day moving average because I want to take you over to the weekly. Now, the line was the 200-day on the daily. Where does that line up on the weekly? Well, look, here at the -1, here's the 1 ATR channel, here's the -1 ATR channel. That will be a level of resistance to try to get above that. So on the weekly, we have resistance there at the -1 ATR channel, and on the daily, we have resistance of the 200-day and also halfway of the big down move. See what I'm talking about as far as we have resistance on the daily at the 200 and the halfway of the big down move, and that same resistance level on the weekly lines up with the resistance of the -1 ATR channel above you. So multiple confluences of resistance. Now, if it just goes straight up and closes above the 200, then no. Now the 200 is support below me, not resistance above me. So if we reject the 200-day moving average next week, I will enter a short. I'll position size, I'll place my 2 ATR stop above. If it then closes above the 200, I'll simply get out and hopefully have a small loss. That's the key to trading, everyone. Looking for multiple support or resistance levels, positioning for volatility, position sizing based on the current market volatility, which the 2 ATR does, placing your emergency stop using the 2 ATR. And then if it closes above what your resistance level is in this case, just simply get out. You're going to have a lot of small losses, but that's the key. You can have big gains. Those, of course, are acceptable. You can have small gains. Those are acceptable. You can have break-even trades even acceptable. You can have small losses. All of this works for the calculus of profitable trading. But the one thing that's going to mess you up is having that large loss and using these 200s, 250s, 30 RSIs as your line in the sand is really what it's about. I don't know if it gets there and rejects, if it's going to be positive. It might be greatly positive, but it might be horribly wrong either. But I've already adjusted for that using the 2 ATR and emergency stops and end of day stops. And again, this is what I teach in my one-on-one course. I teach you all of this, and I will put you through the ringer. Like I said, it's a 15-hour course. We do all sorts of simulation trades. I want to make sure that you know and are taking in and processing what I'm teaching you. And you don't just tell me you got it, you have to show me you got it. And I think that's one thing in my course that sets it apart from a lot of other courses is that I put you in the driver's seat, make you drive. We go through a lot of random charts, random time frames, and I want to make sure you know what the process is and you have to prove it to me. So again, that's what's in my one-on-one course. So for Goldman Sachs, rejection of a close above, close under, intraday rejection, or a bounce at the 200, I will get short. Home Depot, okay, same kind of situation here. 200 up here is going to be some kind of resistance, potentially, right? Potentially, we've had a huge move up, but I need to have the market show me that it's going to reject the 200-day moving average. And if it does, I will get short. Okay, we talked about multiple confluences of time frames. So where does the 200 on the daily dovetail on the weekly? Well, it dovetails right at the 50 SMA. There will be some inherent resistance on the 50 on the weekly in addition to the daily. So see how that works? So it gives me better chances of having a profitable trade if it rejects a level on the daily and on the weekly. Just as simple as that. So next week, if Monday we just close above the 200, then that trade's off, right? Tuesday, if it closes back below, then potentially in. So close over, close under, that's one entry to the downside, one short entry. Rejection of the 200 would be another potential short, and then a bounce, or basically it hits its head and it just goes right back down. It will show me that there were no more buyers up there. So that's what I'm looking for, and the 200 dovetails nicely with the 50-week moving average above it. So on the daily, we have resistance of the 200. On the weekly, we have resistance of the 50, and that's what I'm looking for. Healthcare, same situation. 200-day moving average is above. Where does the 200 line up on the weekly? Lines up very similar to Home Depot with the rejection, or with the 50 SMA on the weekly above. So a good confluence of resistance levels above. It might just blast through it. And if it does, that's fine. Not going to take the trade. But if I get a rejection of these, then I would get short. Now, want to point out, these are all shorts, right? Goldman Sachs, rejection of the 200. Home Depot, rejection of the 200. XLV, rejection of the 200. What about if all three of these trigger on Monday, for example? Am I going to take all three of them? No. Part of my trading and part of my trading success comes down to taking the best trade of the day. Yes, all three of these, Goldman, Home Depot, and healthcare, may trigger a short on Monday, but I'm not going to take the three. I will only take one. That's just part of my process. And which one will I take? I will take the one that has the best looking short, one that has probably the best risk to reward ratio. I'll look at the multiple time frames, see which one makes the sense. But that's part of my trading, and I think it served me well to, even if you have 10 setups, they're all really great. I'm going to narrow it down. I'm going to get out a fine-tooth comb and narrow how does it look on this time frame? How does it look on the weekly time frame? What's the better risk to reward ratio? Oh, maybe they're all the same, but one of them has a V1 and the other one doesn't have a V1. That's the one I'm going to take. So again, next week, what I'm looking for on Goldman Sachs, some kind of rejection of the 200 to get short. Home Depot, some kind of rejection of the 200 to get short. And healthcare, some kind of rejection of the 200 to get short. Now, those are the dailies. And let's go to the weeklies. All right, here we go. Weeklies. Now again, weeklies close on Friday, so I will only look for the weekly trade on the Friday. Okay, here's Alphabet. Well, we've moved up strongly. We're above the 200. If you remember that AMD trade, kind of similar. We moved strongly above the 200 on the weekly, and then we came back down. We could certainly come back down. It would make sense to come back down. If it keeps going up, fine, I don't take the trade. But next week, if we come down, bounce at the 200, or have an intra-week rejection of the 200, that would get me long the trade. Just exactly like Tesla and actually AMD, with the big move up to be expected to move back down. So if and only if Google does get to the 200, rejects the 200 on the weekly, I would get long Google. The $97 price, which is the 200, let's see how that looks like on the higher time frame, which in this case would be the monthly. Yeah, not perfect, but it does have the support of the 50 EMA and the 50 SMA below. So just recap, some kind of rejection of the 200 week, I would get long Google. Johnson & Johnson. Okay, this is a long potential as well. Almost took Johnson & Johnson last week, but it did not reject the 200. This is one of the few kind of areas of stocks where we are low. If we get to the 200-week moving average next week, some kind of bounce intraday rejection, that would get me long Johnson & Johnson. If it just keeps moving up, then that's fine. I'm not going to take it. But if and only if we have some kind of rejection of the 200 below, I would get long. I drew the line here at the 200. Let's see what that looks like on the multiple time frame. Yeah, we have support of the 50-week moving average, 50 EMA below. So that makes sense. So again, on Johnson & Johnson, just some kind of bounce or intra-week rejection of the 200 would get me long J&J. JO is coffee. This is the level that interests me, the 200-week moving average. If it gets down here and rejects the 200, then I'm going to take the trade. If not, I'm not going to take the trade. It's nice on the weekends to look at these charts without the market being open, look and go, where would I be interested? Where would be a good risk to reward ratio? Where would there be some inherent support? Probably the 200. So I draw the line at the 200, 45.20. What does that look like on the higher time frame? Right there at the 50-month moving average. Nice support at that level. So if it gets there, rejects the 200, bounces at the 200, I will get long. If not, I'll pass and look for another market. Pfizer. All right, we are very close to that level. See how we just move down, 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 down. But then when we get to the 200, all of a sudden starts going sideways. Well, that makes sense because buyers come in at the 200. It almost bounced at the 200. I almost took the trade, but it did not. So again, I'm going to follow my process. I'm going to be disciplined. If it gets to the 200, if it actually touches it or it has an intra-week rejection, I am out of the I am in the trade. The 200 here, 39.70 approximately. How does that look like on the higher time frame? Makes a lot of sense here. Quarter below the -1 ATR channel. Already bounced at the 50-week moving average. So I really want to take this trade, Pfizer, if we go down and reject. So that's what I have on the weeklies, a little bit more on the long side, not on the dailies, but that shows you multiple different time frames can have longs or shorts, just depending. Yeah, we're a little overbought on the daily, but there's some potential longs on the weekly. So again, on the weekly, Google, if we come down, reject the 200, that would get me long. Johnson & Johnson, if we come down and reject the 200, that would get me long. And JO Coffee, if and only if we reject the 200, that would get me long on the weekly. And last but not least, Pfizer 200, if we reject that, that would get me long. So Anyway, those are the potential setups that I have for next week. Kind of strange doing this podcast with such few setups, but that's because we've had this big move up. At the beginning of the podcast, I talked about one-on-one lessons. If you do want to learn how to trade, if you want to learn from someone that has been trading a long time and has a lot of experience and has lots of good strategies that they implement in their own trading, then you should consider doing a one-on-one course with me. Like I said, the course does cost $1,750. It's worth every penny. I've taught so many people from around the world, and I would say they are very happy that they took the course. I've turned out some really great traders. I teach you all 5 of the different approaches that I use step by step, and one-on-one is the best way to learn anything, and that's why I offer the course in this format. All you have to do, send me an email. Email's in the link of this YouTube video. If you do reach out, I'll reply and say, hey, thanks for saying hi. Let's do a Skype call. The Skype call is free. It is not a sales call. I promise you that. I just want to learn more about you, your trading, your challenges, your goals, and it's a good time for you to ask me any specific questions about the format of the lessons, what you're going to learn, how it's all going to work. And then when we're done with the call, totally up to you. In the future, if you decided, hey, this makes sense, just email me back. Say, Greg, I want to take the course. We'll set a time and date, and we will get started. If you like online courses, I have a great online course, super affordable. It's at udemy.com. The link's in the description. And in this course, I teach you step by step how to trade the deep dip buy approach. And most of the approaches and the entries that I showed you from this week's trading are based upon the deep dip buy. I think it's only $12 or $15 on Udemy, but don't let that low price fool you because you get so much content. There are 26 videos, there's 9.5 hours of instruction, and 15 study guides as well. I've had so many good reviews from people around the world on this course. And, obviously the one-on-one course is better because you have me personally, you can ask questions, so forth. But, if you're not in the financial situation to do the one-on-one course, starting with the online course makes a lot of sense for $12 or $15. Number 3, if you like today's podcast or any podcast in the past, I would really appreciate it if you could hit the thumbs up button. It does help to build the channel, it lets YouTube know that there's some valuable content around. So if you do enjoy today's podcast and you found it helpful, please, if you could share the video or hit the thumbs up button, I would appreciate it. And then last but not least, always the most important, please try to go out and do something nice for someone today. It would really make the world a better place. You like it when someone does a random act of kindness for you. I'm sure you would. I know I do. And so I try to give back and try to do one nice thing for another human being every day. And if on top of that, if you could do one nice thing for an animal as well, that would really be the best. Animals, I grew up with animals. I'm very close with animals, and they appreciate acts of kindness just like we do. So if you could go out, one nice thing for human, one nice thing for an animal, that's all I would really ask, and it would really make the world a better place. So I hope you're having a good weekend. I hope you had a good trading week. If you have any questions about anything that I mentioned in this podcast, all you have to do, post in the comments section. I'll do my best to get back to you. But for next week, don't get greedy, don't get scared, have a process that you follow, and that's the best way to trade. It really is. So thank you so much for listening, everyone. On the way out here, I have to run the U.S. legal disclaimer, and God willing, I will see you next week. So have a good week. Follow your rules, follow your process, get out of your losses quickly, and let those winners run and have a plan, right? Make that plan, follow that plan. Thanks again, everyone. Have a really great rest of your weekend. See you later. Bye-bye.
U.S. government required disclaimer. Stock, options, futures, and forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.